So this is Noshi from Trade Genie. I trade stocks and options and futures. In this session, I will explain how our trading system works. So from the point of view of as a member, either you're a paid member or a trial member. So we send out trade alerts during market hours, and then we send out the updates. We send out the buy alert, then the targets, the kind of targets we have, I will explain. And then when the targets are hitting, we send out various types of messages, and from time to time we send out the updates related to news or the volume or whether you need to add more to the positions. If it's it has gone down before and now it's moving up back up, or we need to add more to average up. So all that I will explain in a little bit more, something more. So how our trading system works. So let's say in the morning, we prepare, or I prepare, and my team, we prepare the trade candidates in the evening after market close. So there is a process of getting ready for the market. The mental rehearsal I do, the checklist I perform, um, read the news, watch the pre-market action, what's going on in the market, what's going on in the various positions, and then be ready. So done the work of what are the candidates at nighttime, watch list. So watch list, let's say today is Wednesday. So the watch list prepared in the evening of Tuesday night, and if the market is open on Monday, then the evening of Monday. So at least 2 days of Monday, Tuesday, and Tuesday, and maybe something from Friday. So based on the weekly close, so at least 3 days of uh, candidates, and sometimes watch as long as it takes. Let's say a trade which is setting up to fall and is just not getting ready. It's just doing the consolidation at the top. So and expecting it to fall. So then the stocking process starts. So the stocking process is every day watch that, keep that symbol in front and see what it's doing and whether it's doing what we expect to do. And midday, end of day, set the alert for the high, for the low, so high and low, high and low. So keep doing it. So it creates a range. It's creating a resistance. So if we are shorting any stock, we are looking for if it's creating a resistance at a certain zone. So the zone which is at the top of the trend, expecting the zone to hold. And then when the time comes, if we are stalking it symbol properly, then when the time comes, we are ready to take the trade. Or maybe that's the symbol where we are already in a position and we need to add more to the position. So when you reverse the same process is for the calls of going long. So have a bunch of symbols, about 50, 60, um, depending on the market condition. So the basket also fluctuates. So the basket of short and long candidates fluctuates. So also we know what the market is doing. If the market is tilting towards the downside, then if I scan, if it's Wednesday, I'm getting ready for Wednesday, and if I'm preparing for Tuesday, uh, so most of the candidates, if the market is downtrending, then most of the candidates I'll be looking for is to the downside. And if, let's say, the market opened up on Tuesday and it went up, but the overall trend is to the downside, so there will be some retraced stocks. They fell apart too much, and now they on Tuesday because the market was up, so they are moving up. So those are the ones become more good candidate because now we have fresh. We can they are retracing to the upside when the market again starts to fall. Then they are the one who become the next short candidate. or out of those, they could have bottomed out and they want to move up. So depending what they are doing when the market opens on Wednesday or Thursday. So, so that's one of the process. So being ready in the market is the key. So doing your homework. So just like, when we were kids, when we go to school, doing the homework. Like my daughter, she has to submit her homework on Friday morning. So Thursday night, she has to complete her homework, and daddy has to sign. So make sure she does the homework. So it's not like on Thursday she's completing her homework. She has to do some homework on Monday evening, Tuesday evening, Wednesday, Thursday, and then Friday she submit her assignment. So same way in the university, in the college, same way in trading. If you come to market without being prepared, then you're trading willy-nilly, just trying to find something during the market. Maybe you will catch it, maybe not. Maybe you will not catch the proper entry. So you will miss out the proper entry if you're not prepared and come to market and trying to find the candidate based on some Momo, movement. So as long as the Momo is there, you will make money, but you miss the entry. So being ready for the market. So do the homework at night, and then in the morning. So when you done the homework, and when you come in the morning, you're kind of confidence, with the when you do the homework and you go to in front of the teacher and submit your homework, and you feel good inside that okay, I've done the homework, and teacher can ask me any question because I've done the homework and I did the homework myself. I did not cheat. So that's the kind of confidence you get in the morning during the pre-market hours. And then, and then another process is the mental rehearsal. So just like the teacher can ask you questions from the homework, same way the market can ask you the questions from your homework. So if you have done the homework and you come to the market, you're mentally prepared, you have done the mental rehearsal during the market, and you self-analyze yourself, then you're ready for the trades. And then you rate yourself also, how you felt when you woke up, you're ready for to trading. If you have party at nighttime, went to bed late, had a bad diet, etc., so that is all affecting you. So you need to be prepared to come in the market. So fully prepared. So let's say come to the market and it's, depending on what type of trader you are, you have a trading system or you're visual or chart pattern or whatever it is, a trend system. So we get this symbol and say like meta. So meta comes pop up on the screen and it's looking good. Pre-market it was moving and now it was also in the basket of long. So things are there. So if it was in the basket of long and now it's moving also in the pre-market. So that's kind of like a double confirmation that whatever was in the basket for long candidate and it's up in the pre-market. So this is something double confirmation. So you are more ready. So you're more ready. So you analyze the price. So I analyze the price, the stock price, and depending on the target, etc., select the strike. Depending on number of days left, depending on how fast we are expecting the stock to move, depending on where the volume is, open interest is, where the spread is. So all that goes into calculation. Compare the strike with the stock price, where the current price is. And let's say we figure it out, okay, December 130. So let's say we are in the month of November or month of what comes before November, October. So let's say we are in the month of October and enough time for the month of December. So, and the stock is Meta is trading, let's say at 128, 129. So it's not far out of the money if we buy 130, or if it's trading at 132, 131, then 130 will be in the money because 135 is far. So if the stock is trading at 132, 131, then the strike 130 is good one. If the stock is trading at 128, 129, then the strike 130 is good, slightly out of the money. But if mm, and we expect that it may take time for the meta to move towards our target. So we don't want to go far, way out of the money. Another uh, strike could be 135. We can buy 135, but and if the stock is trading at 132, so it's only $3 far, maybe the options are more money because of the time. We are buying more time, so maybe 135. So it depends on various situations, what is going on at that time. So the first message we send is just one line. So no story, there is no story, there is no explanation as to just a short explanation, little bit what we are seeing, but there is no story there. So you don't have to. We realize that the members don't have time to read the story, because if they want to read the story, then they can do the work themselves, or they can read the story later. Right now, this just one tell me what to buy, and I buy. I trust you, and I do what I'm doing. So the first symbol, first is the meta, and then the month, December, and then the strike 130, and then the calls. I think this is written little on calls go first. So meta and then calls or puts. So immediately you know that it's a call trade or a put trade. So meta calls December, then 130 strike, and then buying to open at that price. So we see these the ask and the bid. So somewhere in the middle. So it depends if what is the spread and where the what are the chances of getting filled. If it's trading at, let's say, 1030 and 990, the 1030, or let's say 970, 980, then the suggested price is 10. And also, when I'm sending the alert, I also expect it may be the meta may be moving a little bit to the up to the downside, just a little bit, 10, 15, 20 cents. It will go down to some support, and then it will is expected to bounce. So by the time the alert is sent and the meta pulls back, and the members get filled at 10, even though when I send the alert, the ask was, let's say, 10, 10, 10, 20. So within that 15-minute, 30-minute, meta moves up and down, and the 10 is gets filled. So the stock is meta. So explanation: month is December, the strike is 130, type calls, action buying to open, and then the suggested price 10. And we always buy third Friday expiry option unless it is specified. So sometimes we buy another week expiry. We don't want to go to another month. We expect the trade to close fast, so just buy one extra week, because the third Friday is close to number of days left. So just buy extra 1 week, 2 week time beyond the third Friday expiry. So when we do that, we write it down to tell you what is. Otherwise, it is third Friday expiry. Now, once this trade is sent, we give a gap in providing you the target, because then another email goes. If it goes, and if you're reading the other email with the target, then you're confused. This is the target email. Where is the original trade? So we give a gap of the target, and we watch the trade. So I watch the trade. As soon as the trade is sent, I watch the trade. I watch. So meta is the symbol, December is the month, 130 is the strike, calls, type of trade, and buying to open at 10. So that's what it is. As soon as the trade is open, it should go in your monitoring mode. So just like before, monitoring is a stocking, like preparing the basket and doing the things and watching it is called stalking. And when the trade is open, then it goes into the monitoring mode. So I put it in the monitoring mode. So there are two kinds of monitoring I explain in detail. One is the detail monitoring, and one is the overview monitoring. So I put it on an overview monitor, on a detail monitoring, because it's just the trade we just opened. So it goes in a detail monitoring. It goes in a separate, like it has its own corner, like it becomes like a VIP. Just open it, and we better watch it, because when we are opening a trade, that's where we are making the decision. The most important decision we are making is when we are opening the trade. After that, we leave it to the market, or you can say we leave it to the God, because we have done the homework, all the due diligence. We have accepted our consequence. So you have made the decision. So made the decision that, okay, we think Meta is going up towards 135, 137. It's trading at 128. So 7, 8, 9 point in 3, 4 days, and we need to go long. So whatever we seeing at the time of executing the trade, we are making some decision, and we may be overlooking something. So not all the information is available to the trader. So nobody knows 100 complete information. Even the internal, the CEO, the management don't even know all the information about their own company. They can't, because there are some external forces they are not aware of. They don't know um, what kind of a lawsuit is getting filed against them, or what kind of a government action will be taken, and it will affect their company or the competitors, or what is happening. So they even the internal, the management, the owner, the CEO, the top executive don't know. They don't have that information. So outsiders also don't have. So, but we accept our consequences. So take the decision. So once the trade is open, it goes into the detailed monitoring mode. So I watch and let it stabilize, and prepare the targets email. So we send out the targets email. So the selection of the target is science and not art. So you have to monitor, you have to evaluate your day chart. If you have selected the trade based on daily chart, so select the daily chart, look at the daily chart, where were all the twists and turns on a daily chart. uh, uh, Take a look on the weekly chart also, see where the things are. And then to get the best result from the chart is the intraday charts. Put 7, 8 days of data on an hourly chart or 2 hourly chart, and you can see some changes in that market, the turning point, the resistance, the support, etc. So so we provide three targets. We provide three targets, and not one, but three. So so we call it green, yellow, and red. Also, green means the first target, yellow means the second target, and the red means the third target. So green, yellow, and red, just like traffic signal concept. So when it's green, traffic signal, you keep going, it's all clear. When it's yellow, it's kind of warning sign that you need to pay attention, maybe get ready to stop. And when the red is there, then it means that you need to stop. So red is red. So that's the concept. So I will explain green, yellow, and red. And then there is a beyond red. So sometimes, beyond red is like, um, instead of you stopping at the traffic signal and the red, you just kept going. And then you would reach, let's say you are traveling with your friends, he's driving behind you and you're in the front, and you were supposed to stop at the red, but you barely was there and he was behind you. Crossed the red signal, and you're on the other side and he's on the other side, he's behind. And then you can say, so that's the concept beyond red. So you cross the red signal, now you are on the other side, and he's on the other side. So I will explain what I mean by beyond red. So green, yellow, red, and beyond red. So so when you are executing the trade, so there must be some potential in the trade. Otherwise, if there's no potential, you shouldn't be taking the trade. So the more potential it has, the more profit. And then how much time you expect for the target to hit. That's another thing. And then is there any hindrance in between the targets? So from the entry point where you enter and then where you expect the target, so the distance, are there some hindrances? If there are hindrances, then you have a lot of work to do. Your trade will, you know, take time. So it's like you're going on a freeway, you can take the freeway and you're flying, or you're going internally, you will eventually reach your destination, but you will arrive like 30 minutes late. And then your friend asks you, okay, what happened to you? You said, oh, I took the internal roads. Oh my God, internal road, there were like 10 signals there. Didn't you know? So yeah, I did not know. So there eventually you arrive by taking an internal road, but it took you time. So you missed the party. Whereas one which went through freeway. So it's like this. The stock eventually will hit the target if it takes time. If you're trading stock shares, then the gain will be the same. So if it takes 8 days or if it takes 2 days, the percentage gain is same, but because of the time factor, the compounding effect, you are over the long run, you're making less because the turnover is less. So you want the trade where the turnover is fast. If the turnover is fast, you're making quick deals. So, and if it's you're trading options, then option is a decaying vehicle where every day you have to, like, you're renting it. So every day you're paying the cost. So the more time it takes, the more you have to pay. So we understand all that. So that's why it's very important that when we are trading options, we select the proper options. We give enough time. You don't need a lot of time. People buy 90 days or 120 days of time. That is in my opinion, that's also useless. You don't need that much time, like 90 days. I bought 6 months of time. So in 6 months, I don't know what will happen. I don't know about tomorrow. 6 months, unless I'm a long-term, some based on some fundamentals. Maybe I can buy 6 months of time because I believe in the fundamentals and I just leave it alone or deep in the money. But when we are trading short term, so options are designed for short term trading. So the targets should be such that they should hit quickly. And there should be some momentum there in the stock, some buying going on. So the way the green target is selected is the immediate, like there is no traffic jam. So there is no traffic jam. So when you're looking at GPS, you say, okay, you know, the number one entry in the freeway, and the exit green is number 5. So, and then when you look at the GPS, there is no traffic jam, it's all blue. So you expect the stock to hit, and you don't have any traffic issues or accident issues. So there's a 95% probability of its stock hitting this target. So let's say if the stock is trading at 100, so the green target could be 104 or 105, something like that, 104, 105. So if you buy the option, and if the target is hitting in 1 or 2 days, the green, the 4 or 5 points, so it's 4 or 5%, will give you 30, 40% gain in the options. So when the green target is hit, and we provide the green target, so when the green target is hit, we send the alert to sell like 1/3. So not 1/4, we change, so 1/3. And also a system calculates the percentage gain. So I can see the target is hitting, what is the gain? So I'm watching the position. So green target expected to have at least 30% gains. So if when it's 30% gains, we send out the alert to sell 1/3, or the green target is hitting. And so if you bought 8 contract, you may sell like 2 or 3 of it and expect the stock to continue its momentum to the upside. And when evaluating the green target, there shouldn't, if you're buying call, then there shouldn't be any resistance nearby, near the green target. It's just the temporary natural movement. So the stock moves um, on a daily basis, the stock is moving. It's doing its thing. It's moving. So if it's moving in its natural course, maybe you look at the ATR, the average true range. If on a daily basis, if you calculate, if you look at the ATR and during the last 14 days, and you say, okay, during the last 14 days of the normal meta moves 5 points on a daily basis, on average 5 points. So that becomes the green target. So 5 points. So you add to your entry, which is, let's say, 100. So add 5, which is a 1 ATR or 1.5 ATR, and that is your green target. So once you adding the ATR to your to your entry price, then you need to evaluate if there, and the stock doesn't know you're doing this. Stock doesn't know you are entering at 100 or you are entering at 99 or entering at 98. So stock doesn't know you, and stock doesn't know your trading. So, and you're entering at 100. So based on 100, the ATR, let's say, is doesn't matter if you enter at 100 or enter at 99.50, the ATR is 5. So you say, okay, ATR is 5, I can take 1 ATR profit. So based on 100 is 105. If you enter at 99, then it's 104. So, and then, so you say, okay, this is the target. Now, is there any resistance there nearby? So I'm explaining what I do. So is there a resistance there? I'm calculating the target, let's say at 105. But if there is a resistance at 104.50, then I have to be flexible. I cannot just set the target at 105. I have to lower my target from 105, and I know the resistance is 104.50. I can see clearly on my intraday chart. Then I say, okay, I cannot be just setting my target at exact resistance point where I saw the high was made and then the stock reverse. So I need to lower something. So my target will go to 104. So now I know my target is 104. So my percentage gain will not be 30%. It could be 25%. So one way of increasing the profit at the green target, knowing that I cannot do anything about the resistance. The resistance is resistance. It's there. It's created because the buyers and sellers had a battle over there in the past, and that's where the battle was fought, and the resistance was created at 104.50. So how can I increase my profit? Knowing that I cannot have the target at 105, the target needs to be 104.50 or below. So one way of doing it is, before entering the trade, is lowering the entry price. So how do I lower the entry price? Well, I can lower the entry price by doing my homework, by stocking it. So if before I even enter the trade, I start the stocking process and lower my entry price. So instead of 100, I say I try to get it at 99, try to find some support level at 99 or 98.50. So I watch I do the stocking process. So in this case, I'm lowering my entry price. So if I'm lowering my entry price, I'm coming closer to my stop level, because the stop level could be at 90, 91. So I'm coming closer to the stop level, and I am getting the same target, the profit potential which I expect. So that's one way of increasing the profit, by stocking and lowering my entry price. So as soon as the green target is hit, the system alerts. So we set the targets. So you need to have a proper system of setting all the alerts at the targets. And we get the alert saying, okay, the green target is hit and the trade has a 30% profit. So we send you the trade alert saying the green target is hitting, and the option is has a gain of, let's say, 30% or 28%, whatever it is. So sell 1/3. So we have changed from 1/4 to 1/3. So sell 1/3. So now 1/3 is sold. So we know 1/3 is sold. Now 2/3 left. If you have only one contract, so if you have one contract, then don't sell anything, not the green, because you just have one contract. So depending on your portfolio size, maybe you were not able to buy more than one contract. In the Meta, etc., these big price stock, maybe the option price was like $8, $10, so your portfolio did not afford. You cannot afford to buy more than one contract, so you have only one contract, and then you shouldn't be selling at green target, because green target is like an easy target. But what happened to the traders in general, when some kind of a target is hitting, and they see the green on their screen, they like to ring the register. So because it feels good to ring the register and get some money in the pocket, and worry about the loser later. So in order to feel good, traders just don't follow the rules, don't have any system, they just sell. So just sell and lock the gains. So um, you know temptation. So maybe if you have read the story of Ulysses, maybe you need to follow the rules of Ulysses, or it's called Ulysses contract. So listen to Ulysses, the story. So maybe you resist in selling your contract at the green and hold on to it and wait for the yellow target. So the yellow target is the second target. So we provide the second target. So in case of Meta, if it's 100, if it's trading at 100, we went on 100, and it's trading at the green target was 105. The yellow target could be at 108, 109. So it's we say, okay, we need to calculate some ATR, see all the resistance, and the resistance is at 109. The target is 108.50. So the yellow target is 108.50. And the resistance at 109 and 110 is kind of heavy resistance. It's not very heavy, but there is a resistance. So yellow target is like our ultimate, the optimum target, where the stock will hit and it will pause for a while. So it's like you going on you took the freeway and you just keep going, and exit number 5 is there and is just blue, and you say, okay, I'm cruising, and then you go to exit number 6, 7, 8, 9, and then you see, okay, here is some traffic jam, not heavy, but there is some. So you expect that you will slow down. So that's the kind of a target, which is a yellow target. So, and it has if you estimate um, if you assign the probability, let's say 85%, you cannot be sure 100%. You can never be sure about the 100%. You cannot assign a probability of 100%. That's like knowing the future and with a 100% confidence. So there is a 85% probability of a stock hitting this target. So since there is some resistance above, so in case of calls or in case of puts, there is a support. So stock is expected to pull back. Uh, when the stock hits, there are some resistance, and the resistance is meaningful. Then the resistance means another meaning of resistance is sellers. So sellers sitting there. So sellers are there. They are glad that the stock hit the 108, 109 target, and they want to offload their inventory. So that's what it means. The resistance means seller. Sellers are there. So they will sell. Now, when they start selling, the stock will pull back. If there are more buyers, then the stock will continue its upward move. So that's what happened at the resistance level. So if you recognize, so it's very important for traders to know about support and resistance. That's the key for trading success, knowing the support and resistance. So anything you're buying, you know the buy price and you know the sell price. So the fair price you want to pay. So it's all about fair price. What is fair for you may not be fair for others. So whatever the seller always have a think good about what they have. and the buyer always think the price should be lower. So the buyer is always thinking the price is lower, and the seller is always thinking the price is higher. So if the sellers are sitting there, they are happy at 108, 109. They've been sitting in their inventory for a while. Now they want to sell. So we send out immediate alert to sell 3/4 of your original of your position. So sell like majority. So we send the alert with the keyword majority. So sell majority. So meaning if you have 8 contracts, you sell at least 4, which will be half, or sell 6. So now, when we are selling sending you the alert, if you have been trading and you have a system to monitor and understand better than what we are saying, then maybe you don't want to sell anything. You want to continue. Maybe you will sell all. So it depends. If you have one contract, then sell all. So at yellow. So that is your target. If you have only one contract, then you sell all, because the stock is expected to um, stop momentarily for 1 day, 2 day, it will stop. So what we do is, when the sell majority alert is sent and we know that yellow target is hit, the second target, if the stock doesn't move up in the next 2 days and is doing some sideway move, then we send the alert to sell rest. So sell majority is followed by sell rest. So that's the sequence. Or sometimes we send out the alert saying sell all when the yellow target is hit, because we know that the yellow target has become meaningful. There is more resistance there. It took time for the stock to hit. So instead of hitting in 4 days, it took like 8 days. So 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 we just want to sell and move on to another trade. So there's always something there. So just the optimum target is, another word, yellow target. Now, after the yellow target is ultimate, like red target, where it's a big resistance there. So if we enter at 100, the ATR, let's say it's 5, so 2.5 times of ATR will bring it to 12.5 points. So if we enter at 100, the red target is, let's say, $112.50. And when we look at the evaluate from the resistance point of view, so we say, okay, where is the resistance? Let's see. Is there any resistance at 112, 113? Yes, it is there. So somehow magically the resistance is also there. Okay, what kind of resistance? So it's really heavy resistance. A lot of time the stock tried to break 112, 113, and it failed. So we don't want to like we don't try to prove that we are the champion. So if we know that 112 and 113 is the previous resistance, is heavy, we have nothing to do with that stock around 112, 113. So if the traffic jam is there and the GPS is saying it's a heavy traffic, miles and miles, we exit. We take the internal road. So it's just like that. Or we go on a Starbucks and sit somewhere and drink coffee. So the same, when the red target is hitting and there's a major resistance there, we need to get out at the first opportunity. So when the red target is hitting, before even it hits, my system alert me that the red target is approaching. So you should also set the alert before the red target is hitting. So if it's a 112 is given, then maybe you set the alert for 111. So when you receive the alert of 111 is popping up on your screen, you expect that we will also send you some kind of updates, or to sell all or sell rest. So the the thing is, the further is the target from the stock entry price, the less is the probability of hitting it. So the probability is 70%. And because the distance is far, so the calculation of the time is also not accurate, not 100%. So if you evaluate, if the stock is trading at 100, the target of 101, you can estimate 101 with a very high accuracy of 98% probability. You will say, okay, it's trading at 100. What are the chance of Meta to hit 101 tomorrow? So you would say tomorrow 101, there's a high probability, but 112, there is a 70% probability, but number of days, you calculated 6 and it turned out to be 9. So same concept. So red target, the probability is 70%, and then it will take some time for the stock to hit. So when we and then what because the red target is being assigned based on the heavy resistance, so there is a very high chance that if you try to squeeze every penny, you may regret. So if the red target is 112 and you said, okay, I will set my 112, I will sell all at 112, 112 can hit, and that could be the ask price. And the bid may be 111.90. So by 10 cents, you missed it. So what the traders do, they look at, they set their target like that. They look at their screen. They say, okay, the stock hit 112, but my I missed it, or I set the conditional order. I will explain the conditional order. I set the conditional order, and when it didn't, I was not able to sell my option. So there is some your part. You need to monitor the trade at the red target because you may miss by few cents. And then because it's based on the heavy resistance, and the reason we are selecting the red target because it's far, it has a greater potential. It can give us 80-90% gains in the option, but it's based on some resistance and it's far. So if you miss it, you may regret not selling it because you can expect the pullback. But when it hits, it gives you a high percentage gain. And another thing, if the red target is crossed, I will explain. All the resistance can be broken and all the support are broken. Resistance are meant to be broken, support are meant to be broken. So if the red target is crossed during the intraday movement or during the pre-market hours or during the after-market hours because some news come, then you have a high chance of making more money. So we send the alert. If we have sold before some, then we send the alert to sell rest. If we have not sold anything and it just so happened that the red target is hitting, we bought, let's say, on Tuesday morning, and then on Thursday, the red target hitting, it's better to sell all. So we send the alert to sell all or sell majority or sell rest. So depending on what we have done before. So that is the red target. Red target is based off major resistance and some percentage of ATR. So now the red targets can be revised to the upward. So I'm always looking for the target to be revised, and you need to be on the alert to revise your target on a for all your trades which are coming closer to your target. You need to be on a lookout to see if is there any potential for me or any trade, any target which I need to revise, adjust upward, downward. If you are not doing it, then you're not maximizing your gain, or you may be the stock is about to hit some major resistance and you are still holding it because you ignored. Because when you set the target, when you initiate your trade, there was no resistance at that price. But later on, the resistance was built. So stock do create resistance as they move. So, but when you enter, there was no resistance. So there was, if we enter in Meta at 100 and it's traveling to, let's say our target of yellow is 109, but it so happened that it goes to 107 and then pull back to 106, then it goes to 107, then pull back, then it goes to 107.50, then it pulls back. So some kind of a resistance is there and now is there. You can see the resistance at 106 and 107.50. But if you have not adjusted your yellow target, it is still there at 109. It may hit, it may not hit, and then you regret. So, or you see it intraday, it's moving. Maybe you need to adjust your yellow target to the upside. But when you're adjusting your target to the upside, just make sure, remind yourself that you're not, it's not based on the greed, because when the targets are hitting, the momentum builds up magically and the stock starts to move and it looks like it's like going to fly, and you will miss out all the big gains. And just when the target is hitting, you cancel your sell order, the stock goes up, cross the target, goes up, and then suddenly the waterfall decline starts. And then you are paralyzed because you saw that gains and you cancel your sell order, and now you're paralyzed because you cannot sell. You saw the big gains. So as long as you know that you're canceling it, and you can quickly set the sell order again at the proper price point. So if you cannot, then don't do that. Just keep it at the target and let the stock hit. So red target may change. So I do revise the red target to the upside. If the resistance is broken and I see it intraday moving up, then I revise the red target. So what I do is I move the red to yellow and yellow to green. So if you're still holding, you can see that the targets are revised, or just keep the green and yellow as it is, and the red target is revised to the upside, and then we send you the alert. So in the email, we indicate through the green arrow. So we show you the green arrow. So you can visually, you can see that the target is revised, and we send you the message that the red target is revised to the upside. So hold some. If you're holding it, hold more for more gains. So we do provide this kind of update. So why we so if the red target was selected for the based on some major resistance, so what happened? Why we are revising? So think about like a river. So think of a river. Think of a traffic signal. So the red, when the traffic light was turning red, you were in the middle and you just crossed it on the other side. So you are on the other side, safe zone, and it so happened there's so much traffic behind you, but you cross the red signal, you're on the other side, so you can cruise, and your friend is behind, is stuck. So some kind of a major reason you cross. Or think of a river that the dog was chasing you, and you reach the river, like they show in the movie, the dog is chasing, and then I have no choice and I just jump on the river, and then I have to swim faster than the dog and go on the other side. So instead of swimming, I just magically get the magic rug, and then I fly and go on the other side of the river. So I'm safe, and the dog is on the other side of the river. So same way, the stock gaps up some resistance. It so happened the news comes and the stock gaps up. So you can see clearly on a pre-market level or when the market opened that there's a stock gaps up. So the red target was at 112. Now the stock is trading at 115, 116. So it's way above the red target. So when it's way above the red target, you need to hold because you know that it has broken the resistance. Worst comes worst, it comes to 112, 111.50, then you can sell. So you have to monitor that trade. Sometimes it depends what the stock is doing when it gaps up. If it gaps up, then you pull out your gap up tricks, as if you are analyzing the trade from the gap point of view. So you become a gap trader. So at that point, you become a gap trader, and you say, okay, if the stock is gapping up, and if I was not in the trade, would I take a look at this from the fresh entry point of view? So if the answer is no, and the stock is pulling back, and you expect that the stock gapped up to 115, 116, and it will come down to 112 because that's the resistance, previous resistance, and that resistance will become a support eventually. But so you don't want to give that $4 extra point. So you may sell. So we do send out the alert when the gap's up, and we see the gap is good, but not good enough to hold the position. So we have big gains, and we don't want to hold. Sometimes the stock gaps up, and then it creates a tiny candle. So if you know what I'm talking about, the tiny candle and the gap up trade, so it's like magic carpet. You reach the other side, so now you have a clear cut 112 line, and you can see intraday charts on a 30-minute, 15 minutes that is holding some level, and brand new buyers are coming in. So you need to hold that trade, because that is your chance to make a lot of money on that trade. You got, you can say, um, at this point, it's not the stock gapping up and you are in the position. It's not a skill. You have to recognize that it's a luck. So when the stock gaps up, the trade turns into a lucky trade. You are in it. You did not know that it will gap up. You entered at 100, and now the target was 112, and it gapped up to 115 and 16. So your skill is paying you money, but then on top of your skill, the luck is coming there. So you have a double, I don't know, the blessing of God, that you say, oh, how lucky I am. Now it's trading at 116. So if you can turn that luck into bad luck if you don't monitor it, and it goes to 112, and then it goes to 111 and 110 and 16, 15, it keeps going. So don't do that. Your luck, you need to now apply your skill to hold and manage that trade. So we try to do that, and the some kind of a pullback may occur, or the stock just gaps up and keep going. If the buyers are there and the news is positive, there's no the market maker is not playing any game. So the stock can continue to 116, 118, 120, 122, 124, 25. So you need to constantly do the homework and evaluate that trade. Where is the next resistance? So I do that and see where is the next resistance. So it becomes my priority now, because this is the trade I need to hold and manage. So it becomes a top priority, and it goes in a separate screen called detail monitoring. So it becomes a detail monitoring trade. Now I need to really monitor this trade to capture the gains. So it becomes a higher priority. I cannot leave it alone. So this baby needs some attention. So it's like crying baby, and this crying baby needs some attention, even though it's giving us profit. So what the traders cannot, they get paralyzed when they see big red, and they get also paralyzed when they see big green. So anything big green or big red, they just, we human being, we cannot take action. We cannot believe what's happening to us. We can't believe that this much green is there. So we become willy-nilly, just push the button, sell this, that, this, and then, yeah. And then have 10 contracts, just sold 9, and one is left there, and we didn't even notice that the one was not sold, only 9 sold, and one is hanging there. It can turn out to be another big gain, or that one is losing money. And so make sure you monitor that trade. So when the stock gaps up, it becomes difficult. It becomes a difficult trade, because the gap management kicks in. If it's just moving up and up and up, so any baby can watch that trade. If it's moving up continuously, if it closed at 111 yesterday and it opened today at 112, and it keeps going up and up, so you can, I can give that trade to my daughter, who she's an 8-year-old, and say, I can tell her, hey daughter, watch this trade. If it's going, if you see the red candle on this chart, let daddy know. So she can do that. Anyone can do. It's going up and up and up, and but if it gaps up, she cannot handle it. So you need to monitor that trade, that like an adult, safe to hold, it stays above red. If you see any reason that it is pulling back uh, sharply, then sell it, because if you don't sell, so on the other hand, if the stock gaps to 116 and it comes below near 112, and you forgot that that was your 112 was the original target, you see the green on your screen, biggest green, and then you don't see that much green. Although that was the expected your target, you were expecting the same gain, but because you saw more gain in your on your screen, now you have a remorse. So a remorse set in that I saw this much gain, and now I'm seeing a less gain, so I don't want to sell it, even though that gain was the one you planned on it. And maybe it's more than that because of the implied volatility. The gain is more than what you even at 112 is more than what you plan. But because we saw a lot of gain, the remorse kicks in, and that's where we don't even want to sell at our original plan target because we saw that much pullback. So all that is going on in our mind. So brain, and so think when you're taking action, sell immediately if you see that. If not, then be willing to manage it and maybe buy more. If you see the new cycle begins, sometimes the stock just pulls back to the red target, which was a resistance, and now it becomes a support. So resistance turns support. And maybe if you are a master in trading and you missed it somehow, all of us make mistake. Then maybe you want to add more when a new cycle begins, and then manage it. But we do send you the alert. So revisions of targets. So every day, all trades are evaluated and the targets are adjusted if they need to be. So when we adjust the target to the upside or downside, we send you the revised target, and it shows in the subject line, it shows that we have revised the target to the upside or downside. It shows the up arrow and down arrow next to the target price. So you can see clearly that this target is revised to the upside and this target is revised to the downside. So sometimes the revised targets are revised to the downside also. And the reason is simple. When we enter in the trade, there was no resistance. If we enter in a long trade, there was no resistance at that time at that price. So we selected the target, but then the trade builds up as it progresses from start to finish, or and during its journey, it created some resistance. So it's like you're going from San Diego to LA. Your GPS is saying you will arrive in 1 hour and 15 minutes. So there was no traffic jam. But then as you move, the traffic jam, now your GPS is saying the distance is same, but the GPS is saying 1 hour and 35 minutes. So, it's taking too much time. You may want to exit a little earlier. So constantly review your trades and see if there's any resistance built up, and you need to adjust your target. So we do that, and we send you the alert that revision of targets has taken place, whether to the upside or downside. So it's clearly in your email and SMS. So in SMS also, if you have signed up with your phone number, cell phone, we provide the SMS, and it shows on the SMS also. So the traders who make money, uh, the top traders, they may have a simple entry rule. So they see something, they recognize it, it looks familiar to them. They don't have, they have certain rules, checklists. They go through their certain feelings. They get the gut feeling that this is the trade they take, and they simply take the trade. They initiate a position. So they, how come I can't see you what you're doing? Well, I'm changing the screen and I'm talking. That's all I'm doing. I don't know. If you don't see my changing the screen or I'm talking, you're not seeing me, but the screen you should be seeing the slides changing. I'm at understanding multiple exits. So are you not seeing my screen? Right? You're seeing my screen, right? Okay. So the top traders, they have multiple exits. So you need to have a multiple exits. You can have only one entry, maybe, yeah, unless you have a scale-in strategy that you scale in as the trade builds in, you scale more and more and more. But exits are multiple exits. So multiple exits, the exit could have a different reason, the price reason, and then there are 1 million other reasons for exiting from the trade. So just based on the price, based on the chart, the green target, the yellow target, and the red target. So when one of those targets are hitting, we send you the alert. We send you the alert to sell 1/3. We send you the alert to sell half. We send you the alert to sell majority, depending on what target is hitting. If a green is hitting, we send you 1/3. If it's yellow is hitting, we send you either the selling half or selling majority. If we have sold already the majority or half, and then the rest, we think that you need to sell the rest, so then we send you the alert to sell the rest. Sometimes we send you the first alert goes and sell all, because that's we entered at 100, and the very next day or the second day, the target is hitting yellow target. Some meaningful target is hitting, and the option price exploded to the upside. So it's better to have a 60% gain in 2 days than 80% gain in 8 days. So, this is better, 60% gain in 2 days than 80% gains in 8 days, because the gain, the extra gain, 20 days, 20% came in 6 days, will come in 6 days, let's say. And then there is a probability that you may not see that extra 20%, especially in option trading. So in option trading, the gains come and gains just evaporate. So we do send you those alerts. We also provide you the sell price range. So if, let's say, the target, yellow target is 109, so if the yellow target is 109 and the stock is hitting, it's moving, boom, 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 it's just moving up, and we know that 110, 110.50 is the major resistance, and if it's like 109, then we give you the range, the sell your options between 109 and 110. So give you the range, because not everybody can just the moment we send the alert and then everybody is just waiting and doing nothing and they just sell is not possible. So different traders, they open their emails or alert when they get the time. So when they get the time, they see that, and we giving you the range, so you just sell within that range. So you don't haggle at that time, unless you are monitoring, sitting at home in a comfortable environment, no distraction, multiple monitors, and you making your own decision. So we give you the sell price range. Sometimes the stock moves so much, moving during the day, that we don't know where it will end. It's just continuously moving up, but we want to sell by the market close. So we estimate that is, the trade keeps going, and we keep sending you the alert. And let's say 1 hour left in the market, then we send you the alert to sell by the market close. So 10-15 minutes. If you cannot watch, you sell right away when we send you the alert 1 hour before. If you can watch, you can sell 5-10 minutes before the market close. So just different ways of maximizing your gains, and it depends on who you are, how much time you have, what else you're doing. We're just providing you the guidance with your best interest in mind. Now, there's another phenomenon, which is a pre-market or after-market price action. So traders ignore this, and the reason they ignore, because they come to the market unprepared. They take the trading as a hobby. They hear from someone that it's easy to make money from trading, so let's open an account with Robinhood, put some $2,000 in it and start trading. So it's not that easy. No amount of newsletter, trade alert thing will make you money if you are not doing your own homework and being involved in the market. So it's not some magic will happen. So one of the magic which happen is in the pre-market or aftermarket, especially in the pre-market. So the magic which happens in the pre-market, especially in pre-market, is that the news comes out, and the news is, let's say, positive, and we are in the calls, and the news comes out and it's positive and it's affecting the stock positively, and it just gaps up. So you have to watch the pre-market action, some kind of sense where the low was made and where is the high, especially if you are high, especially if you have a call position, so you're monitoring the high, because that high could be the ultimate high for the day. And if you don't recognize it, let's say your target was 112 red, and the news comes out. It closed at 108 yesterday. The news comes out positive, and it hit 112. And believe me, it does. The major reason get hit in the pre-market hours on the good news. So if 112 was the major reason, it hit during the pre-market hours, and you just see that indeed didn't pay attention, and the market opens, let's say at 111.80, and that was the high of the day. The open was the high. Maybe it goes at 112.10 and 20, and boom, it just suddenly starts um, to crash. So you need to be aware of the pre-market level where the stock hit, especially if it was your red target. If it was your red target and it's hitting in a pre-market in a non-regular session, then that could be that's the indication that the market has hit the major target. Now, the market maker also knows that. So he knows all this. So he's the one who getting all the orders. He knows they are experts. So they all know that this is the target. And if he's an option guy, he will not open the option market for you to sell immediately and make money. He will adjust his books. He will figure it out at what price he needs to open. He will increase the ask size. He will maybe decrease the bid size. He will create a big spread. So in other words, he wants to screw you if you're trying to buy or trying to sell. So he is doing all that in his power. So the 15 minutes, the market just doesn't open. There is a news, and the option market doesn't open, and you see it's not the option is not moving, and the bid and ask is wide crazy, and you say what? The stock is gapped up 5 point and my position is showing red, or my option is not moving. There is no action. The bid is way below what is supposed to be. So you are at the mercy of the market maker of the option. So 15 minutes pass by. When the market open, you calm down. You say, okay, relax, calm down, and then one button on the sell, make sure, and then you're watching on another monitor. I don't know how people trade with one screen in this situation. Is very hard. So only one screen, and especially hard when it's just a cell phone, and it become very hard if the cell phone and the driving. Yeah, so driving, cell phone, rainy, snowing, so all that become very difficult. So and the option market is not there. This close, the market is gapping up. So the normal scenario, if you're sitting at home, you have another monitor to watch your chart, another monitor to sell your order screen, and watch carefully and see where it is. So in this situation, you have to decide if the market gaps up and then it's just coming down. Then you have to decide if you sell at market, if you set the order at market, you will get the worst fill at that time. If you set the limit, you may not your order may get not filled. So you have to decide whether you need to set it in between ask and bid, and watch your order. It needs to be get filled easily, quickly, and all that, because the major target hit during the pre-market, and the gap up will not continue. It will fade. So if some event occurred and it was not, suppose it was not a meaningful market, stock gapped up, and that gap up is not will not continue. So stock will pull back. So if the stock continue upward, then you have a chance. Your skill is coming into play. The stock must gap above the red target. So keep an eye on the red target. So you know your red target. You take a look on the daily chart. So on the daily chart um, you look at it from the landscape point of view. So it's like twinkle, twinkle, little star. When the stock gaps up, is like a north star is just blinking and it's there. So you need to flip your chart to the lower level chart. So that twinkle, twinkle, little star on a daily chart shows some kind of a action on your 5 minute or 15-minute time frame. So there must be some continuous bars moving up. It's not coming down. Or if it's coming down, then you know where it should stop, and then it continues upward. So whatever, you have to apply your skill and decide at that point. So what we do is during the pre-market hours, when we see this, I send you an alert. What should be the strategy? So we send out the pre-market alert and a strategy. The strategy could be that wait for 10, 15 minutes, and this is the price point you need to watch during the first 15 minutes. And depending on where the stock is, you take this action. So we do provide this alert. And the way I do it, I just look at the red target before, and then I see on my daily chart where it is expected to open up, where it will open up, because 5 minutes left. Sometimes I send out 3, 4 pre-market alert, and it doesn't happen often. But when the market is moving up or down, then this kind of alert triggers. So just 5 minutes before the alert is set, it's just a matter of me pushing the send button, and I give you the strategy that this is the strategy for this trade. So you execute that strategy. I give you the prices, and then when the stock is moving up, let's say we are in the call, then I constantly provide you with the update that this is the price hit, and now we are watching this next level. So it's like a journey. The stock is moving up and it's doing its journey, is crossing from one, it's like from one battlefield to another battlefield to another battlefield. It's like this. So the stock is just crossing. It's went to 115. Now the next target is 118. Once it crosses 118, it may stop for a while. It do its thing. It will do its thing, and then it will go towards 120 or 121, and all the way it may go to 125. So I provide that kind of alert during the market hours. So in this kind of situation, when this is happening, I may even say that add to more to the existing position. So adding the same strike may not be the good idea. If it's far in the money, deep in the money, we may buy a new strike. So we say um, you have a December 130 calls. The Let's say the stock is trading at 140, so maybe we say buy 137.50 strike or 140 strike or 145. If the time left is less for the trade, then we may sell that month and strike. We add another month and strike another out of the money, or new month. So we may add a new strike same month. We may add new month and a new strike, or we may create a vertical spread, meaning sell the short calls out of the money. So we capture the gains. So now we have protected our profit. So all that we may sell the puts. So we can do we can do the certain all kinds of like you can take the tricks, what is it called, trick from your hat, pull the rabbit out of your hat, or pull this trick from your sleeve. So knowing what you need to do at this point is adding to your gains. So, or you may just buy a certain number of shares. You say, okay, I'm going to buy shares, or you have shares, you sell the shares and you buy out of the money options. So you can do a lot of things with your portfolio when you come across that kind of trade. So that's the way to maximize gains. We also provide you trade updates. So if there's a meaningful update, we provide you the trade update. Anything, any resistance broken, any trend line, anything which is related, volume update. So I do monitor volume. It's very important for you to watch the volume, whether it's a high volume, unusual volume, average volume, the relative volume. So I do monitor the relative volume. So you need to have a system of watching the relative volume. So I do that. From time to time, I'm looking at the relative volume, I'm looking at the absolute volume. So if the trade is moving up and the volume is also building, then we need to analyze from the price and volume point of view whether this volume is maybe the climax. Sometimes the volume is like 200%. That could be the climax. Nobody left, everybody got into the trade. and now nobody is left for tomorrow. If you see a big volume bar, that is no good. Then unless you analyze it from the technical point of view, from the price action, that even though there is a big bar of volume, but the stock has more potential, so it will consolidate for 2 3 days, and then it has a more potential to go up. So you decide at that time to hold. But we do send out the alert to sell into this volume or hold um, the trade, especially if the so volume itself is not an indicator. So volume itself is not an indicator. People just trade based on the volume. They say, okay, we have developed our proprietary algo, and we send you the alert based on the volume. There's no good. The volume, that day is the day you need to sell. Maybe most of the time when the volume is extreme, you sell. So logic is nobody is left there to buy or sell. So who is going to buy or who's going to sell when everybody's sold out? So we analyze the volume and also the price, and then decide whether to keep the trade or get ready to take the profit. So we send out this kind of update. Sometimes we also need to adjust, buy more. So people say don't average down. I don't think it's correct. Average down at the right price, not just willy-nilly average down. People just willy-nilly add, they buy a 10, and if it goes, option goes to 9, they send the alert. Hey, we bought a 10, it's trading at 950, 940. Should I average down? So answer is no. The average down is not based on where you bought the option and where it's trading. Is based again on the chart. So if the chart is telling you that it's the right time to buy, then add more, otherwise ignore. And another the mistake the traders do, they allocate equal, they buy equal number of contracts every time they buy more. So if they bought 5 contracts at 10, they're buying 5 more at 6, which is not mathematically correct. You need to buy, when you're buying less number of when you're buying at the averaging it down, the formula should be that you are buying more contracts. So if you bought, let's say, 2 contracts at 10, so at 6 you may end up buying 3 because of the equal number of dollars. So you're not buying 2, you're buying 3. So you're buying 3 at the cheaper price. So number of units you're buying more at the cheaper price than what you bought. So your average price goes down, but the decision to buy is not based on the cheaper price, it's based on the technical, whether the stock is hitting the support, now is the time, or the stock is hitting at the resistance. So every time when we are adding more, we should ask the question, and the answer should come yes. And the question we need to ask ourselves is, if I were not in the trade, would I be initiating this as a brand new trade? If the answer come yes, then you should be buying more. And remember the word buying. So buying, remove the word more. If you divide the buying more, the answer is, if I were not in the trade, should I be buying more, initiating a new trade? If the answer come yes, then you should buy. Then you say, okay, what is my formula? So pull out that Excel worksheet, and based on the formula, you say, okay, my equal dollar is telling me that I need to buy 3 contracts. So you pull 3 more contracts. Buy at $6, 3 more contracts is $1,800. Initially, you put about 2 for 2,000, so it's equal. So now you have 5 contracts at maybe at $7.50 or $7.50 average. So once you have that and your decision was correct, then all the green, yellow, and red target, if you keep that same target, you will make more money into the trade, or you can end up losing more, because after buying it may go, the stock can further go down. So if it goes to the target, now if it's even hitting the green target, you are making, in terms of percentage gains is more, and in terms of dollar is more. So now you need to lower your targets. So the red target will come to become, the yellow target will be the red target, The green target will be the yellow target, and then there will be a lower green target. So you have to lower your targets. If you keep the target same, you may not see the gain. So you have to adjust like that. Now, there is one thing. So when we are trading options, but we are reading the charts of a stock. So traders, there's just they come to the market and they say, I have a certain dollar amount target that I want to make 40% gain. That's my objective. If the trade doesn't have a 40%, you can sit all day, you can sit for the whole year, you will never make 40% gain. So it's the chart of the stock which is telling you where your target is. So the target is dynamic. But initially it's constant because you analyze the resistance is there, the line is there, but it becomes dynamic as the market moves. Your stop become dynamic, your target become dynamic. So it's hard to calculate the option price. You can make an estimate based on the delta and say, okay, the delta is this, so this is my option. This, if the stock hit this target, this will be my option price. I bought at 10. Based on the delta, the option will be trading at 15, so I can set the 15. But what if 15 was the ask price and 1480 was the bid price? So you missed out. You did not take into consideration the spread. So then and then what if the volatility went down or some formula, the delta was not correct. There is not, the option price is not just based on delta, there are other variables. So your option calculation was wrong. And even though the target hit and or the target or the stock went towards your anticipated move, and you just sitting there because you set your option to sell at 15. What if it went to 17 and then you sold at 15? So the right way, in my opinion, is to sell based on the stock targets hitting, not based on the option. Option is whatever it is at the price point where the stock is hitting. That's when whatever is the option you need to sell. You if the price is not there, it's not there. What you can do? So in order to avoid, as the time is closer, as the stock is coming closer to your target, then you can anticipate the the accuracy in anticipating the option price is greater when the stock is close to the stock target, your target, and intraday. But it's hard to anticipate, no matter how much formula you use and you calculate, you put all the the interest rate and the dividend and the time to expiry and the strike and the stop. So you can put all your figures in let's say in a Black-Scholes formula. You get the calculator online and you say, okay, I'm a champion, I got this calculator. It's a very secret calculator, I got this from my broker or from some tool, and I can calculate the option price. But then things change, so that price is not there. So the best way is to set the conditional order, which is called activation rule or conditional order, whatever your broker calls it. So on TradeStation, it's called activation rule. In Interactive Broker, it's called conditional order. So conditional order is the order where you set your option. So you can set the option order, sell order, or buy order based on any condition in the market. So it could be a stock target hitting, let's say green target. So you can set the conditional order, sell my contracts at market price when the green target hit. Or you're trading Apple, let's say, you can even do that. You're trading Meta, let's say you're trading Meta. So you have a Meta call and you're saying, okay, sell my Meta calls at market when Apple hit 150. So when Apple hit 150, your Meta call will be sold. If that is your trading strategy, do that. Maybe that's the way you think that Apple and Meta, they move together, let's say, and Apple is trading at 149 and is about to hit 150, and Meta, you don't know. So you think that when Apple hit 150, it will affect the performance of Meta. So whenever Apple hit 150, I expect the pullback in Meta, so I need to sell my Meta calls. Or When S&P hit 3,800, I expect the meta calls to move down. So when S&P hit 3,800, sell my meta calls. Or when NASDAQ 100 hits 20,000 or 25,000, sell my meta calls. So different conditions, sell my meta calls when near the market close. Sell my meta call based on this price, up and down. So there are many conditions you can set via conditional order. But to be very simple, you set your option contract based on the green, yellow, and red target. So sell 2 contracts at green target, sell 2 contracts at yellow target, sell 4 at red targets, equal and less than. So you evaluate your broker and set your conditional order. So I have a different presentation for conditional order. So uh, it's on my YouTube channel, The Real Trade Genie, or I will teach you again. So that's the way you can set your conditional order. Now the conditional order is good and for the option which are trading, which are liquid. So because it's based on the market order. So your order becomes the market order. So you want your market order to be in a liquid stock. You don't want the market order in illiquid stock or option. Then you get the bad fill because they will give you the market order and you will not like it. So make sure your conditional order you're setting is for the liquid stocks like Apple, Baba, Baidu, etc. Those which move and the tight spread. Or and the conditional order is good when you don't have when you know you will not be able to watch uh, your position or you're going away, or when you have many positions open. So you set the conditional order and you can always cancel it. Mm, uh, and just make sure you don't regret cancellation, because when the target is hitting and the option gets sold, it's better for the machine to take over than you coming in with your emotion and making the wrong decision by not selling at the target and then seeing the pullback. So that is a conditional order. And that's the end of today's session. So thank you for coming, and this is it. And I will see you in next few days with another topic. Thank you. Bye.